Hi, everyone, and welcome to Parents Engaging Parents, Beloved Community Check-In. My name is Erica Beverett, and we have a very special guest with us here today. We're going to be having a tax talk, so super excited to hear all that we need to hear because it is tax season, right? We got to get ready to shell out the money or get some money back. So let's see what's going on with the community. Hey, Facebook, how are you? I hope you guys are all listening in. And today we're going to have Andrew Coombs, CPA, here with us. And he is going to tell us a little bit about taxes and what we need to know for 2022. So here's a little background on our guest today. Andrew has started his career in public accounting at the Big Four accounting firm with a focus on corporations and partnership taxes. He's sharpened his skills and decided to broaden his knowledge by switching to preparation and audits. He's earned his bachelor degree in accounting from Loyola University of Chicago in 2009, and he's graduated from Bentley University, where he's earned his master's in taxation in 2010. Andrew is a certified public accountant and a member of the National Association of Black Accountants, the American Institute of Certified Public Accountants, and the Urban League of Essex County. And he is definitely there in Newark to service you and the community. I know he is my accountant, and we're so happy to have him here with Parents Engaging Parents. So I'm going to bring him in now, and he's going to let us in and tell us all the ins and outs of filing our taxes for 2021. Hi, Andrew, and you are muted, so I'm going to ask you to unmute so we can hear you.
How's everybody doing today? It's definitely nice meeting all of you, and I thank Parents Engaging Parents and Al Therese and Erica for having me here to speak about tax and accounting and some best practices. So what I'm going to do right now is I'm going to share my screen. Okay, share screen. Okay. Let me know if you all can see it. Okay. You see the screen, Erica?
Yes, we do.
Okay, great. So what we could do is we could talk about just some high level individual stuff. Then we'll get into businesses, and we'll just start talking about the tax on how it could benefit you, and some best practices. Okay. So my firm is called Coombs CPA. It's a certified public accounting firm. We're going to talk about business taxes, individuals. I know that there's a lot of nonprofits, so we'll talk about nonprofits. We'll discuss real estate, services we provide, and what is a CPA. Okay, so this is basically an introduction, which Erica did a great job doing, so I'm going to skip to that. So, why do we file taxes? As part of, living in this country, they pretty much say part of our income needs to go to the government to fund government programs and to assist, government agencies. So from a high level, we file taxes to support, the government's functions. Okay. So we're just gonna go high level and talk about stuff like the child tax credit, earned income credit, and some other individual stuff. So the child tax credit, it's a tax credit that's available, for children between the ages of babies up until 17. And you get this credit as, the IRS saying, hey, this is a way to say, hey, if you have a child, we know it's expensive, here's a credit, in terms of dealing with that. Okay. Now, what we dealt with this year was the advanced tax credit. The advanced tax credit is people this year, what Joe Biden allowed, he allowed people to receive the tax credit, in advance before the tax return time. However, it's just in advance, it's not extra money. So what you're going to get is if you did the advanced tax credit, you're going to get a form called a 6419. and you have to put that in your return this year. So it's pretty important. You can't complete your return if you got the advanced tax credit without the 6419. Okay, so it should be coming in the mail probably within the next month, hopefully. But just something for you guys to all know. Okay. Another thing is the earned income credit. And so, the earned income credit is a credit that helps, low to moderate, income workers. And it's pretty much giving breaks, for people who have, lower income. This chart to the right shows who's eligible. And it's basically saying, you have to have investment income of less than 10,000. And then, if you have 0 children, the maximum adjusted gross income is 21,000. If you're married, it's 27,000. And then they go up, based upon relatives. Okay. And so, like I said, the earned income credit is a benefit, for, people who earn lower wages. Okay. So we also want to talk about due dates. So individual returns, C Corp, single member LLCs, those will be due April 18th. Dual member LLCs, S Corps, those are due March 15th. Okay. And just letting everyone know, if you have a dual member LLC or an S Corp, you have to complete those business returns before doing your individual return, because the business return, there's a form called the K1 that goes into your individual return. You can't complete your individual return unless the business is done, for dual member LLCs and S Corps. Okay. So we're also going to talk about dependents, and I really like this table. Basically, when you do a tax return, you get a credit for someone who's a dependent, right? And they can be a qualifying relative, or they cannot be a qualifying relative if they meet a certain test, right? And when you look at this right here, this is pretty comprehensive. I like this. It pretty much shows you the steps. It says, is a person your qualifying child or qualifying child of any other taxpayer? A child isn't the qualifying child of any other taxpayer if the child's parent, or any other person for whom the child is defined as a qualifying child isn't required to file a U.S. income tax return, or files an income tax return only to get a refund or income tax withheld. So you say, if yes, the person isn't a qualifying relative. If no, go to step 2. So you pretty much go down these steps, and it tells you, okay, can this person be claimed as a dependent? And what I could do is, maybe after this, I can, email this, and you guys could have this PowerPoint slide for your guidance. But this,
Great.
this is pretty much a matrix saying, hey, this person can be a dependent or can't be a dependent, and it's very helpful.
So,
Okay?
say if I'm taking care of my mom, would I be able to claim her as a dependent?
Absolutely, absolutely. If you're taking care of you, you could absolutely claim her. Okay. Okay, so let's just we could talk high level. So, when you look at taxes, right? If you're like a W-2 employee, you don't have a business and you don't have a multifamily property, the stuff that you could do in terms of taxes is relatively smaller, right? But when you're able to own a business or you own multifamily property, the tax law really opens up for you. You're able to do a lot of other stuff that you couldn't do, if you don't have those things, right? So, like I said, owning a business really does help. So, for example, like if you just have a W-2 job, it's kind of tough because there's only so many expenses you can claim. But if you have a business, you could claim stuff like your business mileage. You have phone bill, internet, home office expense. So if you have a business and you use part of your dwelling, as office space, you could actually claim that as a deduction, which in turn, if you have like a flow through entity, like a dual member LLC or an S Corp, that actually helps your individual tax return. Okay. So if there's anything that you get out of this is that what helps, your tax situation is really owning a business can really help because it opens up the tax law. and also having multifamily property. So, having multifamily property is important because, you get the rental income, right? But you also
Mhm.
have, expenses on behalf of the property. You have mortgage interest that you could deduct. You have property taxes that you could deduct for that property. You have mortgage insurance premiums that you could deduct on behalf of that property. You also have something called depreciation. And so what depreciation is you could take the cost of the property
Mhm.
divided by 27 and a half years, and you take that expense every single year on your return. Okay. And so that
Interesting.
goes on a form called the Schedule E of your individual return, which it really does benefit you on a property because a lot of this stuff, in your personal life, you probably just leave it on the table. But
Yeah.
having a property and having a business really does help, expand the things that you're able to do. Okay.
So
And
how
so,
much of like let's just say
yeah,
if your cell phone bill is in your like your name and you're only in your name, and can you still get a deduction off of that like as an expense if
you
it's
can, but if you're working a W-2 job and you have a business, you can't take like 100% of it, but you
Mhm.
may be able to take like 50% of it or 40% of it because it wouldn't be an 100% business phone because you still work a W-2 job. Okay.
Okay.
Now, if you're doing it full time, yeah, it's full business, but because you have the W-2, you should do a ratio split of that expense, but you can claim it. You can claim it
Okay.
because you're probably using it, some of it, for business reasons. Okay.
Gotcha. Mhm.
Which benefits you. Okay.
Okay.
So yeah, this is just high level. I don't mean to get too granular, but business structures. You have a C corporation, which is by far the least favorable organization, but it's really good if you're a company gonna get institutional investors and big funding. So a C corp from a taxation perspective is the least favorable. Then you
Mhm.
have LLCs, S corps. Um, those are more beneficial because the actual entity isn't taxed; you're taxed on the profits received, and they flow through your individual return. That's why when I said before, you have to make sure when you have an LLC or an S corp, you have to complete the business before you complete the individual. Okay.
Okay.
The next business is a sole proprietorship, which I'm not really big on those because it doesn't protect you from personal liability. So LLC and S corp protects you from personal liability. So if someone sues you, they can't sue you and go after your individual assets. They have to go after the business. Okay.
Mhm.
And so sole proprietorship doesn't really, provide that asset protection. Okay.
So don't be stingy, y'all.
Right. Right.
Have a partner
Right.
or
So,
two or three.
right. Yeah. So just some best practices for businesses. Don't commingle funds. Use your bank account only for business purposes. Keep everything separate. Don't mix with your personal. Have backup financial records. So if you have a computer, just make sure you're backing stuff up. Make you could get like a share file, have things on the cloud just in case. And you can stay on top of your own bookkeeping, or you can hire someone to outsource it. Okay.
We're hiring you. What are you talking
Right.
about? What are you talking about? Everybody's going to Coombs. What are you talking about?
Yeah. So just from a high level, expenses help offset business income, and stuff like recording mileage, like I said, supplies, cell phones, internet, meals. Um, no longer entertainment under the new Trump laws with this tax reform. You could do entertainment if it's a holiday party, they say, but they've really kind of tightened up on that. But like I said before, when you have a business, the
Mhm.
tax law really does open up for you. Okay.
So we have a question from Facebook, and they asked if you're eligible for amended taxes of 2020 and never received. Are you eligible to claim that for 2021?
So they're saying that they amended a tax return for
Mhm.
2020 and they never received the money. Is that what you're saying? I'm sorry, I didn't.
Yeah, it seems like you never received maybe and
A
never
refund?
received maybe any money back or
Oh, from 2020, from the
yeah,
amendment.
yes.
Well, it doesn't mean that
At
you're
the end.
eligible for 2021. The way the IRS works, they stay within the year. But I will tell the person on Facebook that the IRS is they're extremely backed up right now. They were grossly understaffed. They're really trying to hire right now. So I don't know how long the person waited, but for some people, it's taken like 9, 10, 11, 12 months to get certain things processed, unfortunately. So to answer this question, no, it stays within that tax year. So you're eligible to get your refund up to 3 years. After that, they hold on to it. Okay.
Mm, mm.
Okay.
But they won't hold on to that bill.
No, they keep the bill forever.
They'll take your money. Thank you, Brianna.
Yeah. And so this is just very high level. 1099s versus W2s. When you have a W2, there's only so much you could do because they withhold the taxes. You're not as flexible.
Hmm.
1099s, basically they don't withhold taxes, but you're able to treat yourself like a business. And you're able to offset that 1099 income with
Hmm.
expenses. Okay. And so what happens is the 1099, you're able to bring it to a form called the Schedule C and offset it with certain expenses on behalf of that 1099. So, for example, if you drove Uber or Airbnb and you get a 1099, those
Hmm.
expenses on behalf of the Uber, the mileage, you buying air freshener, the certain things that you do on behalf of the car, you're able to offset your income with. Okay.
Hmm.
And this is an example of a Schedule C. Okay. So if you have a 1099, you bring it to a Schedule C and you can offset it with certain expenses. Okay. So I know there's some, a nonprofit, element here. So I just wanted to touch upon it. Nonprofits have to file a 990. If it's below a certain threshold, it's a 990 EZ. And then, for smaller nonprofit organizations, it's a 990N. Okay. And so just, it's a yearly form that has to be filed in the nonprofit industry. And this is like an example of what a Form 990 looks like.
I
They,
like that you said you make sure you're doing nonprofit activities.
right.
So,
Yeah. Yeah. Oh, yeah. If you have a nonprofit, you got to do nonprofit activities.
mm,
Uh, so it's very important. And, best practices with nonprofits, segregation of duties. There's something called the ARC method. You basically, when you have an organization, segregation of duties is very important, especially when it comes to stuff like, fraud or anything happening that could be bad. The ARC
mhm,
method is you have authorization, record keeping, and custody. You want to keep those three separate. You don't want one person doing all three. So one person authorized, one person record keeps, and one person actually has custody of the assets. Okay,
mm,
so just something to note. The segregation of duties is very important. Also, it's good for nonprofit organizations to implement code of ethics. Have a whistleblower policy, a conflict of interest policy, or a behavioral policy for the organization, so that employees know that, hey, this is how you are to conduct yourself in the business. Create an operating budget and make sure you measure that budget to what actually happened throughout the year, so that you can see you're on track with your goals. Okay.
mhm,
Last but not least, when it comes to nonprofit, it's very important to not commingle funds. Especially if you're getting stuff like restricted money or anything that's coming from the government. You have to be very meticulous with not commingling stuff with your personal account. Okay.
mhm.
Okay, and then I wanted to kind of talk about the real estate industry a little bit. in an ideal world, every property should have their own LLC for asset protection. If someone slips and breaks their ankle on their property, on your property, you don't want them to be able to come after everything that you own. That's why a lot of real estate investors have each property in a separate LLC, so that it protects them from personal liability. Okay.
Mm.
I recommend having a separate uh, bank account for each property, and when you get the rental income, put it in there, and then when you get the expenses, have it flow from there. Um, if you are doing flipping of property, do not
Mm.
depreciate, because you have to add it back. If you're gonna hold it, yeah, you depreciate it, that's fine. But if you're gonna be doing flipping, um, it's not worth it to depreciate. You just gotta add the amount back. Okay.
Mm-hmm.
If you own a rental property, it goes on a form Schedule E in your individual return, and if LLC, if it's under an LLC, if unless you're a person personally in real estate, personal property manager, you you,
Mm-hmm.
you put on a Schedule C, but you typically put on a Schedule E. Okay. If it's a dual member LLC, you do a 1065 for it. Okay.
So I have a Facebook question, and it says, "Hello, I just became a homeowner with my mom in December. I have filed a W-2 form with one dependent. Do I guess the next question is, do I use the same form or
Well, you would use the current year form.
okay.
Yeah, that person would use the form for the current year. They want to use the prior year form, but the current year form, yeah. Okay. All right.
Thank you, Cardona Aguilera.
Okay. And then real estate tax avoidance. If you sell a personal residence, you could exclude up to 250,000 of the gain. 500,000 you could exclude from married file jointly if you sell a personal residence, and that's your gain. There are ways, in terms of real estate, in terms of capital gains avoidance. One is called a like kind exchange. It's called a 1031 exchange, where you're basically exchanging one property for another person's property. Okay.
Mm-hmm.
You have 45 days to identify the replacement property and 180 days to complete the sale of a like kind exchange. And it's just a tax strategy, um, to avoid capital gains, and maybe you're basically swapping one property for another. Okay. Another way, in terms of tax avoidance for capital gains in terms of property, is something called an opportunity zone fund. Basically you take the capital gains from selling a property, you put it in an opportunity fund. An opportunity fund is basically what the government said is that if you invest in an opportunity fund invest into distressed communities, and you leave your money in there, and you could take it out and avoid capital gains, but you have to leave it in there for a little while. But it's basically the idea behind putting money in opportunity zone funds is to help distressed neighborhoods develop quicker. Okay. And this is an example of a Schedule E. As you can see, you see the rent received, and then you have the expenses, on behalf of that property. Okay. And then we just give a high level of services that our firm provides. We do CFO outsource. We do payroll. We do audits of organizations. We do taxes for businesses, taxes for individuals, quarterly estimate filing, sales tax filings, bookkeeping, notary, 1099, and we do trainings. Okay. And a lot of people don't really know what a CPA is. Um, and it's important to know this. A CPA is basically the highest standard for accountants. Um, you know, not just in this country, in the world. So a CPA is pretty much the gold standard of accounting. Basically, it's a four-part test, with a first-time pass rate, a 10% pass rate first time. You have to have a bachelor's degree in accounting and a master's degree in accounting. Um, and it's they every single year you have to complete a certain level of CPE to keep the license. Okay, but when you're a CPA, you could do government audits, nonprofit audits, municipal audits, commercial audits. Um, there's so many things you can do, like for self-employed individuals, you could do CPA letters to confirm income, represent the client with the IRS, file certain reports with the SEC. Um, and so, yeah, I mean, if you need to contact us, the website is www.cpacoombs.com. The Instagram is at Coombs CPA. So Instagram is COOMBS CPA. And you can email info@cpacoombs.com or andrew.coombs at cpacoombs.com. And my office manager, she checks both. Okay. And so, yeah, thank you so much. It was nice meeting all of you, and that's all I had in terms of.
Well, we got questions out here.
Yeah,
So
let's go.
Ashley on Facebook asked, do I have to claim a settlement I received from an accident on my taxes, or is that non-taxable money?
Usually accidents is it's usually non-taxable. It's non-taxable. Yeah.
That's really great to know.
Yeah, it's usually
Don't
non-taxable.
go suing everybody.
Yeah, accidents are usually non-taxable.
Okay. Yeah, that's good to know.
Yeah.
How about like some I know for some people like myself, I receive alimony. So is that taxable as well?
So let me ask you this. It did change, but when did it happen? That's the key.
So I would say like let's talk about for this year. If I'm filing and I receive alimony, do I have to claim that as income?
It's not tax deductible, and you got it this year.
Mm-hmm.
Yeah, you do.
Oh, see, I just learned something.
Yeah.
Okay. Does anybody else on Facebook have any questions? I have a couple more.
Sure.
So, what are like one of the best approaches is for like a business to prepare for tax season? Like I know that usually businesses have a lot of different expenses and stuff like that. So, what do businesses do? They generally come in with like a shoebox of receipts? Like
I would say the best thing that a business can do is just if you don't have an accountant, just have your own system. You could get like QuickBooks or Xero and connect it to your bank account and go from there.
Mm-hmm.
Okay.
And have you ever had like one of those instances where somebody comes in with like a bunch of receipts and just says, here you go?
Yeah. I've had it where they dumped it off. Yeah, those are all. Yeah.
Oh, okay. So that's real.
Yeah. Oh yeah. Yeah.
Can you explain? And we have another question out here. Oh, can you explain income versus taxable income?
Well, income is generally taxable income unless the IRS says otherwise. So, basically, most income that you like for the lady that just said the settlement for accident settlement, that's not taxable income.
Mm-hmm.
But most income is taxable income. Okay.
Okay. Unique Johnson is on, and I'm gonna put her up here. And she said, "What if you started a job at the end of the year and you're supposed to claim your own taxes? Do you do the taxes for that job?"
Yeah, you would absolutely.
Mm-hmm.
Yeah, especially if they give you a W-2, you have to do it.
Okay. Cardona Aguilera asks, another question I have, student loans under my belt that I continue paying throughout the pandemic. Will I get a form from the federal loan telling me I paid for my loans?
Yes. So you're going to get a form called the 1098 E, and that is that's called the student loan interest deduction. So you're going to be able to take a deduction off the interest for the student loans that you paid, throughout the year. Okay. It should come in within the next 2-3 weeks. 1098 E. Okay.
Oh, Miss Elise just asked if you receive. Miss Elise, you want to come? You jumping on? Miss Elise is on the move. She's always on the move. So
Yeah.
I'm gonna bring her in.
Okay.
Miss Elise.
Hey.
Hi.
How you doing?
Hi. How are you?
I'm good. How you doing?
Good. So I know that she's Miss Elise is on the road. So she asked.
You know the COVID monies that we received, the government monies that has been received.
Yeah.
Is that has to be put on your taxes as well, right?
Well, no, that's not taxable income, but
they
well, it's not. But the advanced child tax credit, you have to report what you received when you get the 6419 form. By the way, okay, because that's going to reduce your child tax credit. All right.
Okay, so but not the other monies of what you're saying. The other
No, that was it's like a stimulus. Yeah, no.
Right, but the tax preparer asked that question, did I receive stimulus money? And I told him yes. And he said, okay, so that way to let them know that I did receive stimulus money, so that way it can't be deductible. My refund didn't get less.
Yeah, so basically what happens is there's something called a recovery credit, right? And if you received your stimulus, right, then you don't put the recovery credit. If you didn't, you have to file the credit on the form saying, hey, you didn't get it, and it actually boosts your refund. So I think he was asking to see if you actually received the stimulus, if you didn't, he was going to probably put the recovery credit in.
Oh.
Okay.
No, but I didn't. I only received one out of the 3 or 4 that was given.
Mm-hmm. Okay.
So if being that there were 3 or 4 given, it was a select 3 or 4.
I think they were only. I don't think they only gave 3. They gave a first stimulus. I think it was like 1,200. The second was 600. I think the next one was 1,400. And they have an option in the tax return. If you didn't receive it, you get a recovery credit.
And what was the third one?
Mm-hmm.
The third one was 1,400.
No, I didn't get that one.
Yeah. So there's actually in the 2021 return. I see Gigi asked a question.
Mm-hmm.
You actually claim it on your return and the recovery credit. They actually have an option. If you didn't receive the stimulus, you could put the amount in there in the recovery credit, and it actually boosts your refund by the amount that you were to receive. So to answer your question, Gigi, you can claim it on your return through the recovery credit.
Okay. Okay. Unique had mentioned again that she started her job at the end of the year. She said she started her job at the end of the year, and she said she didn't get a W-2. So what would she do in that sense? Would she contact the company that she was working for?
Yeah, I would contact the company that she's working for. They usually have like a portal where you can log in and get it. I mean, you should probably get it within the next 2 weeks. What you could also do if they don't have it, you could get your wage and income transcript, and you could get that from the IRS site, or you can go in person and get it, and they actually have the wages on there. But I wouldn't really do that. I would just ask your employer. They should have it.
Mm-hmm.
They usually have it by the end of January.
Yeah, sometimes early February.
Mm-hmm.
Okay. Let's see. Miss Elku, she asked, what's the difference between tax credit and deduction, and how do I know which is better to use?
Well, the tax credit is kind of a deduction, but they're just on so the credit's on a different line item than the actual deduction. But to answer your question, both are fine. You can get both a tax credit and a deduction.
Oh, you can use both. Okay.
Yeah. There's several different deductions and there's several different tax credits. You can use both.
So that's why we don't need to do our taxes by ourselves, because we might not know all these ins and outs. So that's why we gotta go see Andrew, right?
Yeah.
Okay. What if I run my LLC from home, can I get a tax deduction?
Yeah, so basically how it works, let's say your house is 1,000 square feet. And let's say part of it, let's say you use 200 square feet of it, for business purposes, right? So you're able to take 200 divided by 1,000, multiplied by the expenses on behalf of your household, and you could claim that as a home office expense. So to answer your question, yes, you can. You can't take 100% of it, but you can take the portion of where you do business.
And Cardona Aguilera asked, what is the deadline to do your taxes? So let's talk about on the personal side and the business side. So we're going to go with the personal first. So when is the deadline for us to file our taxes this year?
Sorry, April 18th for.
Oh, all right, y'all. April 18th.
And then for the business, for a dual member LLC or an S corp, it'd be March 15th.
Okay. So if you have an LLC, and I know a lot of us during the pandemic, went that entrepreneurial route, right? So these are things that we definitely need to pay attention and know and take heed, because we have to pay that. And traditionally, I mean, don't we, as far as a business, will we pay that quarterly? How does that usually get paid?
Well, typically with taxes, when you start making income, you do want to do quarterly, because if you underpay, you get hit with a penalty. So for businesses, you typically pay quarterly. Now, if you're a W-2 employee and they're withholding the amount, you don't typically have to pay quarterly estimates as an individual. Now, if you get a lot of 1099s as an individual, you might want to pay quarterly, okay? Because the IRS wants a certain amount of the money, not by April 15th, but by December 31st. A lot of people think it's April 15th, I could pay the lump sum. No, they hit you with a penalty if you're grossly underpaid. Okay.
Mrs. Elku asked, if I run multiple LLCs from home, can I get a tax deduction from each? That's a good question.
Yes, you can. But here's the thing: you can't claim losses for multiple years, because the hobby rules come in effect, and the IRS says, "Hey, this is a hobby. You can only claim the losses to the extent of the money that you earn." So you do need to have a business that eventually makes some income.
Ooh, gonna make your money.
And they assess it every 5 years.
Oh.
Okay.
Okay.
So they don't want people just having massive refunds, taking advantage of all these losses. They want a legitimate business.
Interesting. So, what, like, do you know what the penalties are? Like, say if, I know that for some families, they alternate, children that they claim. Has there ever been, I'm sure there has been an instance where, a parent might claim, a child that's already claimed. Like, how does that work? Does the IRS catch you? Like, do they,
Yeah. Well, usually they just reject the return.
Okay.
They've gotten so good at it now that if they'll see it in there and they'll reject it automatically, since someone else already claimed it.
Oh, wow. Okay.
Yeah. So.
Interesting.
Yeah.
Interesting. Okay, so now I'm going to ask you one of the craziest stories that you ever had in accounting. I'm just kidding. Wow. Hi, Altarise.
Hey, thanks for joining us.
Thank you for joining us. What's going on?
How's everything doing, Andrew?
Good, man. How you doing?
Good, man. I'm checking in, man. I thank you for sharing the information. I had some questions I wanted to ask you, if it was possible.
Sure.
So one thing, the first, I want to double back on that first question. So when individuals receive income, is there a magic remedy potion that you do or CPAs or accountants do to get to a taxable income? Or is the income that they start with is going to be the matter of fact same number, same amount that's going to be taxed when it's all said and done
No,
as
this
far as their return? So that was the question when we saying income versus taxable income.
I
You
got
start
you. I
at
see what you're
one
saying.
level and into another level. So I wanted you to elaborate on that because unfortunately people think it's a miraculous miracle things that's being done. Let's really break down some of those things from our schedule. I mean, excuse me, yeah, from our 1040 and how we start on that first page and get to that back page
Gotcha.
of tax income into actual taxable income, which you actually going to receive your deductions and your tax credit and all these type of different things. So we can elaborate on that a little bit. And I got two more questions I want to tap into.
Sure. So, we basically start off with the income, but then the IRS gives everybody either a standard deduction or itemized deduction, right? And the standard deduction, I think last year was 12,400 for someone single, right?
Mm-hmm.
Or you can also itemize. So, itemized deductions are stuff like charitable contributions, mortgage interest, insurance premiums on a home,
What
property.
schedule will I find that at?
Huh?
Itemized deduction. What
On a
schedule will I
Schedule
find
A.
that?
Schedule A.
Thank
And
you.
so what you want to do is, you look at your itemized deductions and you compare it to um, your standard deduction. And if your itemized is more, you generally go with the itemized. If the standard is more, you generally go with the standard, right? And so then you have the next line item where you have, you know, dependents, anyone you're taking care of, and then you have, stuff like credits, child tax credit. There's energy credits. There's like if you put solar panels on your roof, there's a credit for that. So there's several different credits that you could actually take on the return. Okay, um, and yeah, so basically you have the deductions and the credits, and you ask certain questions, and you get to a point where you get to what the actual taxable income is. So when you start, it's a lot higher, but as you go through these layers, it should get lower.
Sure. And I think and help me out. Is it important to make sure that we have the proof behind each one of those things that we sometimes allow our tax professionals to deduct,
Right.
and take away the bring down to the smaller number that you speak of, because that number could be true and it could be untrue based on certain practices. Am I correct?
Correct. Yeah. So you really want to be able to support everything you put because you don't want to put anything down that you're not able to support. Okay.
And then you mentioned Schedule A and standard deduction. Can we break down the four, if it is four, I believe, different standard deductions? Um, Single, house, head of
Yeah.
household, widow, married filing separate, married filing
Right.
joint. And we can really jump into those four and bring the separation of those four and the understanding of how we really supposed to claim versus the traditional or sometimes the practices in a lot of accounting practices, because there's a difference from CPA versus just being an accountant. So we want to see if we can dive into those standard deductions. And then when we talk about itemized deductions, and sometimes your standard deduction is more than your itemized deduction, and you own property, and you feel as though, oh man,
Yeah.
it's not worth having property because I'm not able to get a deduction, but they're not really realizing that standard deduction versus itemized deduction. So if you can touch those 2 points, I would really appreciate that.
So you pretty much the difference between the two of them.
So first question is the understanding between the standard deductions and the filing status. So that's the
Yeah.
first question. What's the filing status is? Can you
Gotcha.
explain the
Gotcha.
filing status? And
Right.
then can you explain that when you get your filing status, you get that standard deduction for that status. Yet sometimes, like yourself, you may own a home, but if you own a home and your deductions for on your item on your Schedule A is not more than your standard deduction, which one is best to take? And 9 times out of 10, it's best to take the higher number. But then
Right.
people have the belief, the homeowners have the belief, I didn't really get a benefit for having a home because I
Gotcha.
wasn't
Yeah.
able to deduct it because you chose the standard deduction, which was higher based on today's
Gotcha.
your tax year this year. Next year maybe
Gotcha.
different, but this year. So can you talk about that a little bit?
Sure. Yeah. So standard deduction is something that's given by the government, and based upon certain filing statuses, you could be single, married, filed jointly, married, filed separately. Um, Married filed jointly has the best tax rate, but then basically they give you a standard deduction based upon the actual filing status. Okay. Now then, the itemized deduction, just because you have a home or you have charitable contributions, it doesn't necessarily mean that it's going to benefit you if the standard deduction is higher. So if your standard deduction is actually higher than that, it doesn't, in a lot of situations, it doesn't serve a purpose. But in the latter side of it is if you have high charitable contributions and mortgage interest, then it should, there's situations where it's over it. Property taxes, you can only deduct up until like 10,000. So it's case by case basis. So it's not like, some people say, oh, I got a house I didn't get. No, it's just your standard deduction was higher, so you want to go with that.
No, and that's important. And then lastly, just a hyper text on choosing our standard deductions because there's a lot of mistakes in that. And when you get audited or you get when it comes back to you and you don't have that right filing status, it could be a problem. So there's a misunderstanding between picking head of household versus single. There's a misunderstanding picking married filing joint versus married filing separate. And then you got widow and blah blah blah. But those two right there, I think, are really key. Understanding when is the right appropriate time to file head of household, and when is the appropriate time to file married joint, married separate. Because sometimes married people file household, head of household, and single. They don't even file separate. So there's sometimes a misunderstanding and how to really do that.
Yeah, and the biggest mistake that I see is that I see people who try to do who are actually married and try to file head of household.
Yes.
And they've gotten letters and they've gotten audits off that because you can't do that. Okay, because that's like double dipping. I've seen married couples each file head of household, get that $18,000 standard deduction, and one claim one kid and one claim another kid. You can't do that. So the certain filing statuses have certain rules. If you file single, you have to be single. You can't be married. And then if you file married, file jointly, or married, file separately, you have to be legally married. Okay. And I just want to make one correction. Alimony, Erica, alimony, there was a time where it was taxable income. It's not taxable income as of now. I just was double checking. There was a time though. Okay. But it's not. Okay.
Good to know.
So thank you for that, Andrew. Really appreciate that.
Hold on, I've got one more question. What are most deductibles people are not taking advantage of? Like,
so there is actually there's a new one that's kind of hot this year. It's called a 7202.
Mm-hmm.
Okay, this is brand new.
Okay, we got the exclusive.
Yeah, and it's like a credit for like sick leave that a lot of people are going to be using due to COVID. Okay, so that's the newest one that's really hot this tax season. It's called a 7202, and it's a credit for COVID sick leave, which a lot of people are going to be using.
Yeah. No, that's really good to know because a lot of people might not know that that they can.
Yeah. Oh yeah.
Yeah, they can.
Yeah.
We had another comment on Facebook. let's see here. It's Brianna. I'm sorry. It's Brianna McMillan Williams, and she says, me and my husband file separate single head of household. He owed the government. I need to know which is the best way to file for us to get a better return.
Yeah, so you guys are married and you're filing head of house. You shouldn't be filing head of household.
Hey,
Um,
Andrew,
yeah.
before you dive in that, when you answer that question, can you talk on, because the last thing she said, a better return versus filing a legal tax return? Because I think in our community we miss filing a legal correct tax return and receiving whatever return we should receive versus trying to do a tax return and get the best return as if that's the goal versus doing it correctly and getting what we're owed versus trying to finagle some energy to get the best return.
Yeah, that's a great point, Teresa. A lot of people, they keep saying stuff like, "Oh, I'm getting all this money back." You're not really getting all this money back. It's your money. You're just getting back the money that you overpaid the government, right? And I think there kind of has to be a mentality in our community where we're not always talking about refund. The best thing is to have a business, right? And really capitalize off the actual tax law. And situations, in terms of filing stuff legally, you might get away with it for a few years, but when you get that letter and you get that big bill, it's really no joke. So you want to always make sure you're filing correctly. And I want to make sure I answered, I think her name's Brianna's question. If your husband has a debt with the government, you might want to file separately. But just know that married filed separately is the worst tax rate. Okay. Married filed jointly is the best tax rate. Then comes head of household. Okay. So what you might want to do, you might want to file jointly. And, if you're working collectively as a team, it's going to be better as a team to get the best return possible than filing separately. A lot of people file separately when it's an income issue. Like if you show higher income, you have to pay higher student loans. So some people say, I want to file separately because I don't want my student loans to balloon because they go off the tax return of the individual. But for the best return possible, is actually filing jointly for the best tax rate.
You said tax rate. Can you explain a little bit about tax rate?
Yeah, sure. So there's something called tax brackets, right? And if you have a certain income threshold, you get taxed accordingly, right? So, based upon, I think up to 81,000 is like 10%. And then once you go above 81, I think it's like 22%. And the highest bracket, I believe, is like 37%. So it's the more money you make, the higher you get taxed. And so there's every single filing status, whether it be single, head of household, married filed jointly, or married filed separately, they each have their own separate tax brackets and tax rates. Okay. Married filed jointly, if you combine everything, has the best tax rate. Okay. Yeah, we could definitely do that. And I'm gonna send my slides to Teresa and Erica for you all to keep, if you want to use it. And
the people asking for you to come back. The people asking for a part 2. That's what the people ask. We got to give the people what they want. So we'll talk to Andrew because tax season is right now, and I know he's about to get deep into it. But if we can steal him another opportunity, we definitely want to. But we got to definitely respect his brothers getting on the grind and so many others making sure our community is getting the best return. So we definitely are champion trying to get them back. Ma'am, definitely, Ms. Cardone.
Awesome. Yeah, and also, we could always play this back on YouTube. It's available on YouTube if you subscribe to Parents Engaging Parents on YouTube. It's there. You could pause it, you could rewind it, and you can get all the information you need if you feel like you missed something. So, Andrew, Marietta Cozy just gave you a shout out. She says, Andrew, thank you for joining us this evening and sharing this important tax information. We appreciate you.
Thank you, Marietta.
Yes, we do.
Definitely. In this beloved community, we definitely want to make sure that regardless of our, accolades, our academic elevation, that at the end of the day, this is a community of brown, black, and poor individuals, and we want to make sure we come out of the rut. And a lot of that is going to be building wealth and building generational wealth. And a lot of Americans have built generational wealth through taxes, through the information they know, the way they was able to, finesse the energies. Some people only pay $700 in taxes and they billionaires. you know, so so we want to make sure that we have as much information for our community to be enriched with opportunities. Because listen, every quarter, every dollar count here in our community. So we thank you, Andrew, for sharing this information. And I know Erica will want you to definitely, before you leave, any words of wisdom, advice, direction, especially in this 2020 year coming up, and so many things have changed in the last 18 months when it's come to taxes. Every year tax laws change, and I think a lot of us in our community don't truly appreciate and know that we expect year to year it to be the same exact thing, and it's truly not. So I end with that on my side. I thank you for sharing your information.
No, thank you, and I appreciate you all for having me here, and I appreciate everybody, for coming. Really means a lot to me. I would just say, you can speak to a professional, or just make sure you're thoroughly doing your research, because a lot of things do change, and like I said, they have that credit, the 7202, and there's a lot of new stuff going on due to COVID. So just make sure you're abreast, and yeah, if you all have any questions. We're on Instagram, Coombs CPA, COOMBS CPA, or you could go on the website, www.coombs.com. We can answer any questions.
Or you could take a ride down McCarter Highway and just look at the biggest billboard out there and get that information from up there too. But definitely, Erica, I turn it back over to you guys. Thank you. Please, guys, parents engaging parents. Erica, thank you again. And I look forward to talking to you again, my friend Andrew. Thank you.
Yeah, thank you.
All right, Andrew, many thanks to you again for joining us this evening. It was a bucket of information.
Yeah.
And like I said, it's definitely available to you. You can rewind it. You can scroll back on Facebook and view it again. It'll be there on YouTube. And please, if you can, donate to Parents Engaging Parents. You can check out our website. It's pepnj.org, pepnj.org. And so we can continue to do this work. All right.
Thank you.
Thank you so much for joining us.
Yep.
Have a good night, everyone.
Take care.